Have you ever wondered how a covered call trade really plays out from start to finish? In this episode, I'll walk you through a live scenario on the QQQ ETF. That's right, that's the NASDAQ 100 ETF. We're going to be buying 100 shares, then immediately selling an at the money covered call. Specifically, you'll get the answer to these three big questions. What happens if the call expires worthless? What happens if the call goes in the money? That means that the Qs actually rise in price above the strike price of the option that we've sold, and your shares are assigned, or as some call it, called away. And is there any way to keep your shares and continue to make money on those shares, even though the underlying stock has blown through your strike price and your covered call is ready to expire in the money? Stick around, because in the end, you'll know exactly how each of these scenarios can play out so that you can handle the various outcomes that are sure to come your way, just like a pro. Here we go. All right, so we're going to be digging in here, and this particular episode is focused on building on the last episode on options, which I believe was episode 126. So a couple episodes ago. Today, this is 128. And we've received a lot of positive feedback. A lot of people are saying, wait a second, I have ETFs or I have stocks, and, the idea of earning income has sort of intrigued them when they have these stocks sort of sitting there. And of course, ETFs, many ETFs anyway, have little dividends or maybe even no dividends. But that's not really why you have them. So for example, the NASDAQ 100 is a tech focused ETF. So we're looking at all the big tech, right? So you've got big tech like Apple in there. You've got, NVIDIA, you've got Amazon, you've got Tesla, you've got all these tech companies. There's the top 100 are in this ETF, which provides you some great diversification. But like you might have recognized, when we buy this ETF, we're sort of buying it, holding it, and just sort of waiting and seeing what will happen. We know in the long run, the market typically moves up. So it's definitely a positive move. Now, this is not the SPY. The SPY is the S&P 500 ETF. SPY is sort of, an easy way for you to buy all 500 companies. However, note that some companies are weighted more than others, so based on market cap as well. So we're not suggesting that you pick the Qs, but because I had a trade on with the Qs this week, I thought I would share a scenario with you. Okay, and I tried to map this out so that we can make this as clear as possible. So full disclosure, this is not my actual trade. This is a trade that you could have made this particular week as I'm recording this episode, okay? And we're actually only going to look at a very short time period for this particular trade. And what I want to give you is I want to give you an opportunity to kind of see, how does this look, right? Like, so, we were talking, it's great. Like, it sounds great. Can we earn income on our stocks through a covered call? Amazing. What's the downside, right? Because there are some downsides, as we discussed in the previous episode. We talked about this idea that you're kind of capping your upside on the actual appreciation of the stock. So you can do one of two things. If it does work through your strike price, so if that stock value, in this case, if the Qs pushes through the strike price of your covered call, you can just sit on your hands and wait for it to be assigned or have those stocks called away. And then you'll get all that capital back. And then you get to rinse and repeat. You can go and buy the Qs again if you want to, and start selling covered calls on that again. So today, what I'm really going to be focusing on is just kind of giving you some insight into how covered calls can give you sort of a different view on your stock portfolio. I'm not here to recommend what you do. I'm not here to tell you that this is the only way to go. I'm just telling you that this is a way, and it's something that might be worth looking into further. So we'll look into a specific scenario with you here today. So first off, I'm going to be sharing the screen. I'm doing my best here to make sure that, folks who are listening on the podcast instead of on YouTube, so that you can actually see what's going on here. But I'm going to go ahead and share this screen here. just to give people a heads up as to what this might look like and sound like. So, in today's discussion, we're actually using real numbers based on kind of what's been happening this week. And specifically on Tuesday, January 14th, this is 2025. Again, the actual timing doesn't really matter, but if you wanted to go back and sort of check the charts, you'll see that like these numbers are real. So on Tuesday, we're going to buy, and again, I did not buy the Qs on Tuesday. I actually had the Qs from a previous trade, a few months back. So this is not something I had to do, but I wanted to show you if I did decide on Tuesday to purchase 100 shares. That's one of the caveats we discussed in the last episode, is that you can sell a covered call on 100 shares. So one covered call contract is controlling 100 shares. So this gets kind of pricey. Like this isn't easy to do on a stock like or an ETF like the Qs, where it was trading at $505, because now you're talking about a $50,000 investment, $50,500 you need in order to buy 100 shares of the Qs. Now, you can do this with other stocks as well, right? Like there's some people right now that are in crypto mania, and they're, they like Mara, or they like Hut, or they like some of these other stocks out there. Now, full disclosure, we have done a whole lot less of individual trading, just because I don't know if you remember 2021, where every stock was doing great. Everybody thought they were a trader, and then we experienced a big downturn. Well, guess what? Did that Mara stock look so good in your portfolio when it was worth, 30% of its original value, right? So you just have to be cautious. You don't want to go blind into this and just pick anything, right? But the reason I tell you that is that cheaper stocks mean a cheaper amount of capital required here, right? So if I picked something that was a $30 stock, right, 100 shares of $30 stock is only going to be $3,000, right? And then you can sell covered calls on that. Now, the nuance is, when you do sell covered calls, things are relative, right? More risky stocks are going to have a higher premium amount. Lower risk stocks are going to have a lower premium amount. So you're going to find that if you go and, you like Enbridge, because like Enbridge is a great dividend stock, and, it's pretty steady Freddy. It's not like up and down and all over the place. Well, guess what? Your options premium is going to be a whole lot less on a stock like that. However, it actually might lend itself more to a strategy like this, where your goal is that, hey, listen, if I get assigned and the shares are called away, I just go ahead and buy the shares again, right? So there's all kinds of ways to do this. But today we're going to look at the Qs. We've purchased 100 shares for $505. So $50,500 have been purchased. For those who are familiar with stock options, you might be like, oh, I'll just do a synthetic, or, something like that. Yes, we're hoping to get deeper into some of these ideas as we move along here, but we're going to start with the basic here, like super basic, something that pretty much anybody could do if they chose. So we've got these stocks. These are now in our account. So we own these shares. We are in full control of them. And what we're going to do, and I'm doing this right away. Now, there's some people that would say, well, don't sell your short position right away. Why? Well, normally I try to buy when there's a bit of a dip. So why not wait for the shares to come back a little before you sell your covered call? So I'm not going to talk to you about strategy of how to maximize here. I just want to show you that, hey, if you bought the shares and then immediately after on the 14th, if you sold a covered call, right? So you're selling this call option to someone out there. Somebody out there is gambling by taking the call option from you. You're going to sell it to them for a cost. They're going to give you money in order to essentially hold control of your shares until expiry. And I just want to highlight here. So this is Tuesday the 14th. If you sell the 505 strike price. So I bought it for 505 and you sold the 505. Okay. So that is at the money. That is right at the money there. Someone was willing to, on Tuesday, to pay you $6.16. Now, some people are like, wait a second, is that like, how do you know that? Well, you can actually go back and you can look at option premium. Now, because I started setting up this episode on Tuesday the 14th, I basically took that price, threw it down so I could see it. But if you go to barchart.com, you can kind of play with, options chains, and you can kind of explore there. There's a lot of great information there. And that's where I took the rest of the information from here to map this out for you. So we've got a 505 covered call that we're going to sell for $6.16. Now, some people are like, that's not a lot of income on $50,000. Well, you're right, because that $6.16 is how much they're paying to control each and every one of your stocks. So every individual stock is going to get $6.16 for the right. Now, we're doing it in one contract, which means we have to, or they have to, control 100 shares of mine, which means that $6.16 is really $616. Now, once again, some people are like, okay, $616 on $50,000 isn't that much income here. Like Kyle, you might turn it off right now, but I want you to look at when this option expires. And I did this intentionally because, the shorter the time frame, the easier it is for me to kind of map this out for you. This is a option that expires on January 17th, on Friday, January 17th. So you sold the option on the 14th, on Tuesday. This person has only a handful of days till the Friday the 17th for the stock to go up or down. And if it goes down, then it will expire worthless. So basically, it's a coin flip. If you sell this call option at the money, it has what they call a delta of 50%, because 50% of the time we expect it to go up and 50% of the time we expect it to go down, right? So you're pretty much at a coin flip right now as to whether you're going to win or lose. So I want you to pause for a second. You've got 3 days. Someone's giving you $616 in order to flip a coin with you so that they can take the cues from you. Now, here's the thing. We're not talking about, this isn't your firstborn, okay? So it can be really hard. FOMO is a real thing, right? But I want you to remember that if someone takes your shares, you can buy more. There is an endless supply. Now, the hard part is whether you'll be happy to buy them at whatever the price is or not, right? So it's easier to do this strategy than, say, a rent to own, where you're giving someone the option to take a property from you, because over time that property might appreciate more than you thought, and so forth, and you put so much love, care, and effort into it, you might go, shoot, I wish I never did that. Well, here, the same feeling comes, but I just want to remind you that if someone takes your shares, you will get your 505 back, because you bought, or you sold, I should say, a covered call at $505. So basically you're saying, listen, if it goes through the strike price, I'm going to get all my money back from the Qs, and I get to keep this $616 as profit for a 3-day trade. Okay. So I want to just, flip to the next screen here, and I want to share sort of what happens, in the scenario where it expires worthless. So let's fast forward to Friday. Now, I have no idea what's going to happen. I'm actually recording this on Thursday, the 16th, right? So I don't know what's going to happen tomorrow. But what I do know happened yesterday is the CPI data came out, and the Qs actually jumped by $11. So we'll talk about that, because that's really what's happening. But let's pretend by tomorrow, Friday, the end of day, 4 p.m., when the market closes, the Qs are at exactly 505. Okay. So you bought it at 505 on Tuesday. You're going to basically close on Friday at 505. Basically, what's going to end up happening is one of two things is going to happen. Okay. Now, if you actually let this thing expire, the actual call, your shares would be called for 505, right? And actually, I've never had it happen right on the money here, right on the, on the dollar. So technically they could take your shares at 505, and you're left with nothing. Now, what I think would more likely happen is you probably just buy back this option, because the option's going to lose value. We'll talk about that in one of the other scenarios. But let's just assume that this person's like, yep, I paid $616 to own this at 505, and it ended up being worth 505 by the end of the 3 days, and I'm going to take it for 505. So technically, you now have your money back in your account. You have no money in the trade in terms of the base position, which is the Qs. And your actual option that you sold, it was worth 616 on Tuesday. But each day, if it stayed at 505 every single day, now that would never happen, of course, right? We're talking about sort of an improbable scenario. But let's pretend it did. It stayed at 505 Tuesday, Wednesday, Thursday, Friday. What's happening to the option is it's becoming less and less valuable. Why? Because there's less time in order for that stock to do something, right? So basically that 616, like by Wednesday, if it's still at 505, it's going to be worth less. By Thursday, it's worth less even still. And it's actually going to be more aggressively, it's going to increasingly be worth less, meaning it's going to almost, it's going to actually, almost like this exponential idea towards zero though, right? And it's going to aggressively get towards zero. So ultimately, by like the moment before the market closes, this thing's going to be worth $0. So your $6.16 that you earned per share is now worth $0. So like before it closes, if you wanted to keep the shares or you wanted to guarantee that you'd keep the shares, you could just buy it back for like a penny or 5 cents or something like that. Now that's 5 cents per share, right? So there's a cost to that, right? So it would be 5 cents, you'd end up multiplying that by 100, right? So you just kind of think about whether it's worth it to you or not, just to kind of wrap up the trade or not, or you just let it expire and just see what happens, right? Sometimes right at the end, at the close, there's a bump up in the market and so forth. So in this case, you've earned $616 in 3 days, which again, I'm not denying, like that's not a lot of money compared to the money that you had at stake, $50,000. However, that's a 1.22% return. When we annualize that, that's like 148%. Okay. Now, is it realistic that you'll be able to do this every 3 days consistently? And keep in mind, you actually could try. You could keep it 3-day gaps, but most stocks trade either monthly or weekly. But some of the bigger ones, like the Qs, some of these ETFs will actually trade on like a daily or an every other day schedule. So like you could do really short-term trades, right? So you could keep, essentially, it's kind of like keeping things tight so that the stock can't sort of get away from you too far. So I tend to keep things about a week out, 2 weeks out. Some people do monthly. It's totally up to you. But we're just showing this very short trade that obviously if you could repeat, you're going to walk away with some profit here on a 3-day trade, right? Now, let's talk about if it expires worthless because the stock went down. Because like in this scenario, you're like, man, I'm going to do this every day, all day long, right? That's great. But here's the thing, though. The reality is like it's probably the stock's either going to go up from 505 or it's going to go down from 505. So let's talk about like what happens if it expires on Friday the 17th and the stock is now worth 504. So it's actually lost $1. Well, you can see here in the spreadsheet, we're at losing $100 on the base position, right? So like if you were to sell, even though the option's going to expire worthless, right? If the option expires worthless, but let's say you were like, I just want to wrap up this trade. I don't want to own the Qs anymore. You could sell them back to the market. You're at $100 loss. So whether you realize that loss by selling or whether it's an unrealized loss by holding, you're now negative $100 on the base position. You bought at 505, you're selling at 504, or at least it's worth 504. However, your option expired worthless at the end of Friday. So since you paid or you were paid $616, your $616 now, you have a net profit or a total profit on this trade of about $516 by the end of day Friday. Why is that? Well, the stock's worth $1 less, but because you sold a covered call, you made 616. So the difference between those two is going to be 516. Make sense? So that is sort of a risk that we have. Like if this thing expires worthless $6 lower. So now it's like it's closing at $499. So you bought at 505. It's closing at $499. Technically on paper, you are $600 underwater with your Q's base position. So whether if you sell it, you're crystallizing that $600 loss. If you keep it, you're still negative $600 on this position, right? Like that's where you are in the portfolio. However, because you sold this covered call for 616, you're actually at a $16 profit. So why I picked $6 was to make this really clear to you that, it basically is creating you a little bit of downside protection at the same time. You know me, I'm a very, very cautious individual. I've done some dumb things. Don't get me wrong. I've done some risky things that, maybe at the time I didn't think were that risky. But I try to seek consistency. I try to seek protection. So this is one of those ways where you're kind of like protected to the downside. And now you basically are at a place where it's like, hey, if you wanted to, the very next week, you could sell a covered call at the money, $4.99, to repeat the process. Because why? Well, you're still technically in a profit. You're $16 of profit in your pocket. If the Qs continue to go down next week, you will have more downside protection, right? So you can kind of see here, if you're tracking this, that you're actually creating yourself a little bit of protection from who knows what the market might do. The real goal here, though, is that over time, that you make sure you're keeping track of things, because I don't want this to take a sharp nosedive and then sell covered calls at the money and then it takes off from you. Now it's like you lost your shares for a big loss. You made some premium along the way, but you could be at a net negative if you're not paying attention, right? So you want to be paying attention here and don't just aimlessly do this strategy. All right, let's talk a little bit about if this expired in the money a little bit. Okay, so if we go in the money by $1, all right, and I think that in the money by the dollar is right here. So if I look at expiring in the money by $1, basically what's going to happen is the numbers are going to look very similar to our very first scenario, right? So even though it's in the money by $1, that means the stock's trading at 506. If you don't buy back the actual call before the end of the day on Friday the 17th, what's going to happen is they're going to take your shares and they're going to pay you 505 for every share. So you don't get any of that dollar upside, but you still get to keep the 616. So your total profit here is 616 again, even though the stock went through your strike price, right? So right now you're going, that's not that bad, right? Like that's not that bad at all. It's like I've actually earned more on this by Friday, except they've now taken my shares. So I either have to rebuy the shares if I want to go, or I have to maybe put it in a different equity. It's totally up to you what you choose to do, but you still have $616 of profit in that case. Now let's look at what happens if we buy this thing back. If we buy back the call, we're looking at this here and we go, well, what we're trying to do is we're trying to keep the shares. So I'm going to buy back my call, but you'll notice that it's going to be worth less. And I'm going to pretend for a second here that you buy it back like a second before the market closes. Now, I would never recommend doing that because that's going to be way too close. But why I'm saying a second before it closes, because what I can tell you is that at the moment before it's closing, before the market's closing, basically that 616 call that you sold, so you sold $6.16, it's only going to be worth about $1 at that point. Why? Well, because there's only $1 arbitrage between what the Qs are trading at, 506, and where it is, 505. There's $1 difference there. So that option right before expiry is pretty much worth only $1. There's no extrinsic value there. There's no time premium left for someone to earn, right? So it might be, $1.05 or something. You know what I mean? Like there's somebody out there trying to make a little bit of money, right? The market makers are trying to make a little money, but it's going to be at about $1, right? And basically what that means is that you're going to keep your shares, which are now worth $100 more than you bought them for, but you're giving back $100 to buy back your contract, your covered call, right? You got 616 for every share. now you're paying $1 for every share. So that $616 is reduced by 100 and you get 516. What you're going to notice is your profit's the same again, right? You know, look at me. I'm trying to plan ahead here and give you some scenarios to kind of show you how this might play out. Now, these are, feel like fairly perfect world scenarios. What I want to show you is what really happened yesterday. So this is on Wednesday, January 15th. The CPI numbers came back and they were better than anticipated. Slightly. So the market liked that. And the long bond market seemed to like that too, because bond rates were going up until this point. The market was a little shaky. And at least yesterday, what ended up happening is the Qs jumped up to 516 and 70 cents. So that's like it went through the strike price by $11.87. $11.87. So that's like not super awesome. And basically, what I wanted to show you here is that by Wednesday, there's two things that we could do. Like we could say, oh my gosh, I have FOMO now, and I want to make sure that I keep these Qs now somehow. Like what would happen if I wanted to keep the Qs? Well, what I would do is if let's say that this happened and I wanted to buy this back, I looked yesterday at what it would cost to buy back the actual premium. Now, the stock went up $11.70 above the strike price, but to buy back the option, it only costs $11.87. So why I'm telling you that is like you're looking at it and you go, oh my gosh, like if I want to buy this back, I have to pay almost double what I sold it for, which doesn't feel logical, right? Like you're like, I don't want to lose money, right? You can see here, it's like if I pay $1,187, I'm going to lose $571 in order to do this. And you're like, oh my gosh, like that's really crazy. Like, why would anyone do that? Well, you would have received $1,170 of upside on the Qs, right? Because that's how far it went through the strike price. Now, I'm not advocating that you do this because, again, I could always buy more Qs if someone takes them from me. So I'm not going to do this, but I just want to show you the math behind it so that you go and you look and you go, oh, you still have a profit of $599 should you have chosen to do that yesterday. So if you're like, I regret selling the covered call and, now I just want to keep my, my stock and blah, blah, blah. It's like your 616 basically got reduced by, a total of about $17. Now you're at $5.99 of profit based on the growth of the actual stock that you're holding. But I'll be honest and say, this, in my opinion, is actually the riskier option to take, right? Because, what happens if the day after it comes down again? If it comes down again, now you have no risk protection. Like you have no downside risk protection by having that covered call in place, right? So what you've done is you're paying this large amount of money. It's almost like without realizing the gain in the Qs, you're going to pay it out of pocket in order to keep this unrealized gain in the Qs. Not my thing, but it might be your thing. So that's not what I'm going to do, but maybe you would. And I just want to show what that looks like. So instead, what I would probably do is just let this thing expire in the money. If you were, I'll actually explain what I would do. I wouldn't let it expire in the money necessarily, but if you did, you'd walk away with your 616 of profit. Somebody else is going to walk away with a large profit right on the covered call because they bought it from you and the payoff, the bet worked for them. So they've got a nice upside there. They're going to have probably over $1,000 of profit there. But you're going to still have your 616 and you're going to get your 50,500 back. And then you get to rinse and repeat and decide, hey, what do I do from here? But what I would rather do, and this is what I typically do, is that I would rather roll my option. All right. So what I have here is basically instead of selling the stock on the Friday and basically just getting my $50,000 back, I'd rather keep the Qs and sell more options on it. And you might be like, well, Kyle, how do you do that? Well, I just showed you a few minutes ago, you can buy your call back. So people in the trading world would call this rolling your option. I can roll the option to a further out expiry. And that's actually what I'm showing you I'll do here. So let's pretend that this thing on Friday, just before close. The stock's still up $11.70 above my strike price. So it's going to cost me about $11.70 to buy that back near the end of the day. Well, I can do that. And at the same time, I can sell another call a week out. Now I'm going to go from, instead of the 17th, this is going to be the 24th. So a full week out. And I'm actually going to keep the strike price the same, 505. And you'll notice that I can sell it for $13.80. So my net benefit here is 826 when I consider the 616 I sold, the 1,170 that I had to pay to buy it back, and then I made another 1380 on this trade. So my 616 profit went up to 826, and I get to hold the cues for another week, right? And we get to do it all over again. Now, some people might say, Kyle, listen, well, like eventually, like 505 is going to be an irrelevant strike price if, let's say, it just keeps going up and up and up. And you're absolutely right. Eventually, you might just let it expire and then you start over. You find a place to buy back in and you go again. But other people actually roll up. So what I might choose to do is I go, listen, I want to actually roll this thing up, and I wanted to get to what was the number here? I think I wrote it down incorrectly. I believe it was like 507.50 was the call that I could purchase a week out. And the price of that was just slightly higher than what I had to buy the 505 on the 17th back at. So basically what I'm trying to do is I'm actually trying to push my strike price up in the next call by $2.50. And I'm actually not losing any money by doing so. And you'll see here the total profit is going to be about, $875 on this total trade, because now we have some unrealized gain in the queues, plus we have $625 of option premium. So in today's discussion, what I'm trying to do by sharing this screen and giving you one scenario is, and this went way longer than I anticipated it would. However, it does make sense because there's so many different options, hence the name, that can happen from one decision that you make, right? Which kind of raises two flags here, right? You've been exposed to this idea. I wouldn't recommend anybody to just dig in and, blindly hop in and start selling calls and not understand what's going on. You want to make sure you're on a good platform to do so. There'll be a link in the show notes if you want to use IBKR, which is Interactive Brokers. Feel free. You'll get a bonus. We'll get some sort of bonus. It's there just because it's the platform we use, but Sink or Swim works, or Think or Swim, I think is the name of it. There's all kinds of other platforms out there that are helpful. Probably not your straight up big bank platform is going to be super helpful here, because, they might charge a lot to sell or buy a premium, a contract and so forth. But make sure you know what you're doing before you dig in on anything. The purpose of this episode is to really just give you a sense of what's out there, like what is possible. We receive calls all the time from people who are saying like they want to find ways to like be more in control of their financial future. Well, guess what? This is one of those ways, right? I can go and I can set and forget, which is fine. There's nothing wrong with doing set and forget portfolio. We're not trying to advocate against that at all. But for those of you who are trying to figure out, like, what can I do? How do I do this better? Is there any opportunity for me to do something and, maybe that I was unaware of? And the answer is yes. This is one of those. I would encourage you to do some learning about it. There's some great books. There's a book by Lee Lowell. I can't remember the name, but it's on our book list on CanadianWealthSecrets.com/books. You can go check that out and do some learning. But that's something that I would definitely encourage you to do, because here's the thing. Set and forget, it works. It will work. In the long run, it will work. But like, if you look at an example here, like this is the Russell 2000. Okay, Russell 2000 ETF. So 2,000 small cap companies in the United States that are here. And you'll see that back in November 2021, it reached an all-time high. And if I just did the buy and hold, and let's say I bought it right at this all-time high, it seems to always happen to, people, right? They get in right at an all-time high, and then boom, things go all the way down. It went down over 30% over the next 6 months. And then it took another year and a half to get and touch all-time highs this past November. And now it's down again. And actually, how much is it down by? Let's take a look. We'll measure it up. So from this all-time high, it's now down back to down 9% again, right? So these things can happen even with an ETF, right? It's a small cap ETF. So of course it's more volatile. But imagine if in between we were to make some income along this journey so that it's not all dependent on whether the stock price goes up or down or sideways. It's like you can control a little bit of that, because guess what? It is hard to predict what's going to happen next. I thought this was a big bear flag here, and look, it dropped and it faked us out and then went boom all the way up. It's hard to predict what's going to happen. So finding ways that you can protect yourself and make some money in the portfolio at the same time without doing anything emotionally charged or too risky can be certainly helpful. One thing I do know for certain is that 2 podcast episodes will not do the trick to start, but what you can do is start the learning process. So I hope this has been helpful for you. Friends, if you're an incorporated business owner, this is one of those strategies that can be helpful. You can spend 15 minutes a week or a month doing this. If you trade monthly calls and don't worry too much about, pick your strategy and move. If you are an incorporated business owner and you are looking for ways to unlock your retained earnings, make sure you sign up for our masterclass over at canadianwealthsecrets.com/masterclass. It's completely free. It's chock full of amazing ideas specifically for business owners, for our other friends who are not incorporated. If you filled up your RSP, your tax-free savings, and now you're trying to look to what next? Smith maneuver, should I be leveraging, permanent insurance policies, whatever that might be, head on over to canadianwealthsecrets.com/discovery to book yourself a discovery call so we can try to help you take your next move along your wealth building journey. All right, my friends. It is Kyle for this Friday episode, and I'm signing out. I just want to give you a quick reminder that this is not investment advice. It's for entertainment purposes only, and you should not construe any such information or other material as legal, tax, investment, financial, or other advice. Just a reminder, I am a licensed life and accident and sickness insurance agent and VP of Corporate Wealth Management with the PanCorp team. That includes corporate advisors and Pan Financial.